Welcome back. Every hour, a government facility in Washington, D.C. turns blank paper into U.S. dollars. The machines run nearly nonstop, pumping out hundreds of millions of dollars in cash. It looks like this is where money is born, but that's the sideshow. Physical cash is only a tiny portion of all existing dollars. The real money, the trillions that actually move through the economy, never gets printed at all. It lives as numbers inside bank servers, and those numbers grow by billions of dollars every single day. So where do those trillions come from? Before a dollar appears in your bank account, it's usually been created, multiplied, and passed through banks, the U.S. government, or the Federal Reserve, often starting as nothing more than a loan or a line in a database. Your employer didn't pull it from a treasure chest, the government didn't laser print it, and banks didn't grab it from a secret vault. Someone, somewhere, literally typed it into existence. So the real question isn't how does the government print money, it's why do numbers typed into a system behave like actual dollars? And why does the world accept it? Money seems simple until you try to define it. So before we talk about how the U.S. creates money out of nothing, we need to get clear on what nothing actually means. Because in the world of money, nothing isn't a void, it's the absence of physical stuff. And strangely, that absence is exactly what makes modern money work. Start with the obvious. Most US dollars don't exist as cash, not even close. Physical bills and coins make up only a tiny percentage of all dollars in the system. The rest, the overwhelming majority, are nothing more than digital balances inside bank databases. They have no shape, no weight, and no physical presence, yet they behave exactly like real money because everyone involved agrees to treat them that way. If that sounds like a massive shared hallucination, you're not wrong, but it's a very organized, legally enforced hallucination with spreadsheets, auditors, compliance departments, and enough rules to make your eyes glaze over. When you check your bank balance, you're not looking at your money, you're looking at the bank's promise to give you money if you ask for it. Your dollars exist only because the bank says they do, and because the system trusts that the bank will make good on those promises. Here's the weird part. The system doesn't require the bank to have your money physically sitting in a vault. It just requires them to keep track of who owes what. That's why your balance can update instantly, even when no physical object moves. It's accounting, not treasure handling. Think less pirate chest and more Google Sheet with consequences. Here's a relatable analogy. Think about the digital photos on your phone. The image feels real and permanent, but it's just data, numbers arranged in a way your brain interprets as something meaningful. If the file changes, the photo changes. If the file disappears, the photo disappears. But at no point did anything physical have to exist for the image to feel real. Modern money works the same way. It feels real because the record feels real. So when people say the U.S. creates money out of nothing, what they really mean is modern money is built on promises, records, and trust, not metal, paper, or physical scarcity. The nothing is simply the lack of a tangible object backing the number in your banking app. Which brings us to the next question, the uncomfortable one. If money is mostly digital promises, who gets to create those promises in the first place? And why does the system allow some institutions to conjure brand new dollars with a few keystrokes, while everyone else has to earn them the hard way? To answer how the U.S. creates money out of nothing today, we need to rewind to the moment humans accidentally discovered trust could be turned into a financial superpower. It starts with something small, human, and completely relatable. A favor. Picture this. A farmer needs a tool. The toolmaker agrees to hand it over now, and the farmer promises to come back with food later. No coins, no bills, no contracts, just a verbal IOU, a promise of future value. That promise is the earliest ancestor of every dollar in your bank account. Now scale that up. More people begin trading IOUs. Then communities start using physical goods, grain, cattle, salt, because they're easier to trust and harder to fake. Useful, yes, but clunky. Try carrying 10 cows to the market. You'd get tired before you even started haggling. So humans upgrade to metal, gold and silver coins, small, durable, universally valued. All of a sudden, the trades accelerate. But these coins have a fatal flaw. Moving them around is heavy, risky, and about as fun as dragging a suitcase full of rocks through airport security. All of that hauling metal around worked until everyone got tired of living like part-time pirates. So the people eventually looked for something safer and easier. That search led them to the goldsmiths of 17th century London, craftsmen who almost accidentally became the world's first custodians of money. People stored their gold with them for safekeeping and in return received paper claim checks, receipts saying, "You can get your gold back anytime." These notes were portable, easy to trade, and instantly more convenient than carrying the gold itself. And this is where the story takes its most important turn. Goldsmiths notice something strange. Almost nobody comes back for their gold. People just trade the paper around. So the goldsmiths do something clever and slightly sneaky. They start issuing more paper notes than the amount of gold they actually hold. When a merchant asks for a loan, the goldsmith simply writes a new note, backed by nothing but confidence, and hands it over. That single act increases the total amount of money in circulation without adding a single new coin. The gold stays in the vault, the new note floats around town as if it's backed by something real. As long as everyone doesn't show up demanding their gold at the same time, the system works. This is the moment money stops being tied to physical objects and starts being tied to trust, records, and expectations. The goldsmiths created wealth out of nothing for the very first time. Not by mining, not by printing, just by issuing promises that people believed. And that simple trick becomes the blueprint for every modern banking system on Earth, including the one the US uses today. If the goldsmiths were the first to create money out of nothing, then modern banks are the industrial-scale version of that trick, bigger, faster, and far more influential. And this is the part most people misunderstand. Because when you deposit money into a bank, the bank is not storing your cash like a museum artifact. It's recording a liability. Your deposit is literally the bank owing you money, not the other way around. The flip side is where the magic starts. When a bank gives someone a loan, it doesn't reach into a vault full of customer deposits and hand over neatly wrapped stacks of bills. It simply types a brand new number into the borrower's account. Instantly, that person has money that didn't exist seconds earlier. No gold, no printing, no physical transfer. Just accounting entries that the entire financial system agrees to treat as spendable dollars. This is the modern version of the goldsmith's extra notes, but now wrapped in regulation, digital ledgers, and very expensive cubicles. And just like the goldsmiths, banks can safely create more promises than the actual cash they hold because they know people rarely demand their money all at the same time. As long as withdrawals stay normal and loans get repaid, the system works smoothly. To see how this plays out in real life, imagine someone taking out a loan to buy a car. The bank creates new money by adding a fresh deposit to the borrower's account. That person buys the car, and the dealership receives the payment as a new deposit at their bank. The dealership then uses that deposit to pay employees, who use it to pay rent, groceries, streaming subscriptions, and everything else. One keystroke at the bank becomes a chain reaction of transactions powering dozens of people's lives. None of that economic activity required the bank to reduce its vault of cash. The money used for the purchase didn't come from someone else's account. It came from the bank's willingness to create a promise and the public's willingness to trust it. In today's world, this mechanism, bank lending, creates the overwhelming majority of all dollars in existence. But the same engine that accelerates economic growth also injects instability. Because money is created as debt, a slowdown in lending can freeze the entire system. When people borrow aggressively, money flows fast. When people stop borrowing, money creation stalls. And suddenly businesses, workers, and consumers feel the squeeze. It's like powering a city with bikes. Everything works as long as enough people keep pedaling. The moment pedaling slows, the lights go out. And that's where risk creeps in. If banks make too many bad loans or if borrowers start defaulting, the created money evaporates as loans disappear from bank balance sheets. Banks shrink their lending to protect themselves, which reduces new money creation even further. A credit crunch is basically the banking system putting itself in airplane mode at the worst possible moment, something we saw in the market crash of 2008. Here's the catch. Unlike goldsmiths, banks can't create unlimited money on a whim. They need enough capital, enough collateral, and enough confidence in the borrower to avoid getting stuck with losses. Regulations may guide them, but ultimately the decision to create new dollars flows from incentives, risk calculations, and how optimistic they feel about getting paid back. Even with those limits, their ability to create new dollars with a few keystrokes remains one of the most powerful forces in the U.S. economy. And it raises a crucial question. What happens when banks run low on backup money or confidence starts to crack? Who gives them the fuel to keep creating new dollars? That brings us to the next layer of money creation, the version controlled by the U.S. government and the Federal Reserve, where the stakes get even bigger. If banks are the day-to-day creators of money, then the U.S. government is the plot twist most people never see coming. The institution that can spend money into existence even when it doesn't have the cash up front. And yes, that sounds suspiciously like cheating, but it's baked into the design of the system. Here's the plain English version. When the U.S. government spends money, it doesn't check its bank balance first. It authorizes payments, salaries, contracts, Social Security benefits, and those payments show up as brand new deposits in people's bank accounts. In other words, government spending injects new money straight into the economy. No printing required, no vaults involved. But where does the government get the money it spends? Not from a savings account, not from a treasure chest. It gets it by issuing IOUs called treasury bonds. A treasury bond is basically the government saying, lend us money now, we'll pay you back later with interest. Banks, corporations, pension funds, regular investors, and even foreign countries buy these bonds because they trust that the U.S. will pay. Here's the mechanism in action. The Treasury issues a new bond. Someone buys it, and the money used to purchase that bond goes to the government. The government then spends that money into the economy, paying workers, contractors, engineers, agencies, and anyone else on the federal payroll. All those payments land in bank accounts as brand new deposits. Just like that, money that didn't exist before is now circulating through the economy. But the problem is the U.S. government almost always spends more than it collects in taxes. That gap is the deficit. And to cover it, the government issues even more bonds. This is the loop. Issue bonds, receive money, spend money, create deposits, repeat. It's not a one-time trick. It's the engine behind almost every dollar the government injects into the system. Now add the Federal Reserve, the government's banker and system's safety net. The Fed can buy existing government bonds from banks by creating new reserves out of thin air. These reserves aren't the money you spend, they're the money banks use behind the scenes. But when the Fed creates new reserves, banks suddenly have more room to lend, more liquidity, and more ability to keep the whole machine running. The Fed doesn't need tax dollars or gold bars to do this. It presses keys, numbers change, money appears. Here's the weird part. The interaction between the Treasury and the Fed means the U.S. can expand the money supply without touching a printing press. Government spending pushes money into the economy from the front door. The Federal Reserve expands the system through the back door by making sure banks never run out of the special fuel they need to operate. This is why people say the government prints money even when no printer is involved. Spending creates deposits, bonds supply the fuel, and the Federal Reserve expands the system when banks start running dry. It's a mixture of fiscal decisions, financial plumbing, and strategic trust all working together to manufacture dollars from digital nothing. So yes, the U.S. really does create money out of nothing. Not with a magic wand, but with a cycle of spending, borrowing, and central bank support that turns promises into dollars and dollars into economic activity. The natural question is, if the government can create money this easily, why doesn't it simply create as much as it wants? Why not erase all debts, boost every budget, and shower the country with dollar bills? Because creating money is the easy part. Living with the consequences is where things get complicated. Money creation sounds empowering until you realize the system can wobble the moment reality stops matching the promises. And that wobble usually shows up as inflation, inequality, or a sudden economic slowdown. This is the part people feel in their daily lives, even if they never think about the Federal Reserve or Treasury bonds. Start with inflation. In plain English, inflation happens when more money is chasing the same amount of stuff. If the money supply grows faster than real production, prices rise. You're not imagining it, your grocery bill really is higher because the money in the system outpaced the goods on the shelves. It's like adding more players to a game without adding more pieces. Suddenly everyone is scrambling for the same few spots. A simple example, imagine a town that produces the same number of cars, houses, and sandwiches every year. If banks suddenly double the amount of money people can borrow, demand jumps while supply stays fixed. Sellers raise prices because they can, buyers complain because they must, and the whole system absorbs the shock through higher costs. But inflation isn't the only consequence. Because money is created as debt, someone must be willing to borrow for the system to keep expanding. When confidence drops, whether from recessions, layoffs, or global uncertainty, borrowing slows down. That means fewer new dollars enter the economy. Suddenly, businesses stall, banks tighten lending, and consumers pull back. It's the economic version of everyone slamming on the brakes all at once. And just like that, the same mechanism that fuels growth becomes a bottleneck. When money creation depends on borrowing, any drop in lending becomes a drag on the entire system. Debt makes the system powerful, but it also makes it sensitive. One bad shock can ripple through banks, businesses, and households in a matter of weeks. Now add inequality to the mix. Because new money enters the system through loans and government spending, those closest to the source benefit first. Banks, corporations, and asset holders feel the effects before workers and consumers do. This first-touch advantage means money created at the top can inflate stock prices and real estate long before it improves everyday wages. It's like refilling a fountain by pouring water at the top. The upper bowls overflow, while the lower ones wait their turn to receive that water. Here's the uncomfortable truth. The system relies on everything going mostly right. People need to trust banks, banks need to trust borrowers, borrowers need to trust the future, and the government needs to trust that its promises will be honored indefinitely. One crack in that trust chain can trigger inflation spikes, credit freezes, or economic slowdowns. At this point, it might feel like the U.S. money system is a precarious tower of IOUs held together with confidence and caffeine. So why hasn't it collapsed? And why does the dollar remain the global heavyweight champion even when other countries run similar debt-fueled systems? The short answer? is trust, specifically the industrial strength version built on scale, habit, and global dependence. The dollar isn't just a currency, it's the world's operating system. And once the world standardizes on an operating system, switching is painful. Start with size. The U.S. economy is big, diverse, and crucially, predictable. Investors don't need perfection, they need reliability. When other currencies wobble, global money tends to sprint toward the dollar, not away from it. That flight creates a feedback loop. Demand builds stability, and stability builds more demand. Then there's utility. Countries hold dollars to buy oil, though a few countries are now trying to pay for oil in anything but dollars just to make a point. Countries settle international debts and support their own financial systems. Corporations borrow in dollars because it's safer. Foreign banks keep dollar reserves because they trust U.S. institutions more than their domestic ones. Every one of these decisions reinforces the dollar's dominance. The Federal Reserve is the last major pillar. During crises, the Fed acts as the system's global shock absorber, pumping liquidity into markets and signaling that dollars will remain available. In 2008 and 2020, this backstop prevented panic from turning into collapse. When everything shakes, the Fed becomes the anchor. Global trust makes the system more resilient than it looks. The U.S. can run deficits, expand credit, and absorb shocks precisely because so many governments, companies, and investors rely on the dollar's stability. It's self-reinforcing confidence. But trust isn't invincibility. Every system has limits. The real question isn't whether the dollar collapses tomorrow. It's how long a promise-based system can hold when the world keeps testing those promises. And that leads us to the final piece of the story, what all this means for you. If there's one takeaway from this entire journey, it's this. Money isn't metal, paper, or even numbers. It's a system of promises. Promises we collectively trust enough to build an entire economy on top of them. The U.S. creates money out of nothing because nothing in this context is really confidence backed by scale, habit, and institutions powerful enough to keep that confidence alive. The wild part is that every dollar you've ever earned, spent, saved, or stressed about began as either a bank's loan, the government's spending, or the Fed's behind-the-scenes support. None of it needed physical printing. All of it relied on trust moving faster than fear. So what does this mean for you? It means the value of your money isn't about what it's made of, it's about the stability of the system backing it. As long as the promises hold, the dollar works. When the promises crack, the ripple hits everyone. Planet Earth now owes over $300 trillion. Everyone's in debt. But that raises a hilarious question. Who's on the other side of the receipt? Mars? Jeff Bezos? A committee of aliens charging intergalactic rent? Click the video on the screen to find out.